Welcome to the Create More Value podcast, sponsored by Fortuna Advisors, the boutique shareholder value improvement advisory firm. Create More Value is a series of conversations with senior executives, board members, investors, and other experts that have overcome challenges to create exceptional value for their companies. There are many ways to drive value, so we cover a wide range of topics. I am the host, Greg Milano, founder and CEO of Fortuna Advisors, and I hope you enjoy the conversation as much as I did. I would like to welcome my good friend and former colleague, Steve O'Byrne. Thank you, Steve, for joining me on our Fortuna Advisors podcast, Create More Value.
Thanks, Greg. It's a pleasure to be here.
Stephen O'Byrne is the president of Shareholder Value Advisors. He has more than 30 years of experience as a consultant to companies on compensation, performance measurement, and valuation issues. He was previously a senior vice president of Stern Stewart & Co., where we met, and a principal of Towers Perrin. He is a certified public accountant, a member of the Illinois Bar, a member of the New York CFA Society, and a former lecturer in mathematics at Loyola University of Chicago. Steve is one of the smartest people I have ever met. He thinks deeply about incentive compensation and business performance and the ways in which human behavior is shaped. At the same time, he is an expert with statistics and has developed fact-based perspectives on matters that seem vague and qualitative to others. He is the co-author of the book EVA and Value-Based Management and numerous papers and articles in leading publications on subject matters such as 3 versions of perfect pay for performance, how competitive pay undermines pay for performance, and employee value added, a new measure of gain sharing between labor and capital. Steve, I've been looking forward to this discussion for quite some time.
Me too. And thank you for inviting me to join you.
Tell me about the early history of executive pay.
Okay. Actually, before we get started with that, it's useful to just go back over the basic objectives of executive pay, because in my mind, those have been the same since the end of the 19th century when we first had big corporations. And I always think of those as really 3 things, is that you're trying to create strong incentives to increase shareholder value, but you're trying to do that while at the same time retaining key talent and limiting shareholder cost. So when we look across the history, we don't really see, to my mind, any deviation from those objectives. What we do see, though, is a real shift in focus, particularly from incentive strength to retention as the most important objective. So let's move on from there to just sort of talk about the design of executive pay in the first part of the 20th century. And the basic concept was really value sharing. And a plan that I frequently use as an example is General Motors. In 1922, they adopted a bonus plan that made incentive compensation, both cash and stock compensation, equal to 10% of profit above a 7% return on capital. And they use that formula without any change in either the sharing percentage or the threshold return for 25 years. And they use the same basic formula with slight changes in the sharing percentage or the threshold return for 68 years. So it was an incredibly long-running plan. And when you look at what other companies were doing in the early part of the 20th century, it was very common to have a similar plan that was really sharing in an economic profit measure. And if you think about those plans in terms of the basic objectives, when you have a fixed sharing percentage, that generally gives you a very strong incentive, because it means every incremental dollar of profit means additional bonus. So it gives a strong incentive. It also limits shareholder costs, because if we're limiting the bonus pool to 10% of profit, then cost doesn't go above that. The challenge is really with retention, because economic profit can be poor due to market or industry factors, and that just means there's no bonus pool. And so for a plan like that to work well, it really needs to be well managed so that they build up a return in good times and draw on that in bad times. And that's actually what General Motors did, is that they would not use 100% of the formula amount every year. They would actually build up a reserve and use that to increase bonuses in years when performance was poor. Now, to really appreciate the benefit of a fixed sharing plan like that, we need to stop and think a little bit about management incentives. And I've always sort of thought that the right starting point is really discounted cash flow. That when we think of the value of the company, we think of that being the present value of expected future cash flows. And to me, it's very useful to think of executive wealth in the same terms. That for an executive, his wealth, his or her wealth, is really current stock and option holdings plus the present value of expected future compensation. And when we think of it in those terms, it's easy to see how a plan like the General Motors plan creates a strong incentive, because when economic profit, or the profit above the 7% capital charge, increases in the current year, it's very likely to increase in the future years too.
Mm-hmm.
And you're going to share in it at the same rate. So that means that the whole stream of expected future pay is going to go up when performance is good this year. So that's sort of the basic structure that was used in the first half of the 20th century.
So why did fixed sharing die out? What caused that to happen?
Yeah, that's a very good question. And what really does happen is that it stays largely in place during the Depression, and to a certain degree in the Second World War. But in very many cases, those bonus plans are out of the money, because during the Depression, profits are low, so that you have a 10% share of profits above 7%, but profits are below 7%, so that you have a share of nothing. I think that was really a very significant factor, because we have not only the Depression, but then that's followed by World War II, where there are excess profit taxes and a great deal of animosity to profiteering and high bonuses and things like that. So that that really sort of cuts the steam out from under those plans.
So if we fast forward then to after the Second World War, what changed? How did it evolve after that?
Okay. Well, first, very interesting thing is that the Second World War is the occasion for an enormous amount of personnel research and talent management, because so many people are in the military, and the military is trying to decide what to do with them and how to evaluate them and how to allocate them to their most productive role within the military. So that there is a huge explosion in aptitude testing and analysis of jobs and person capabilities. And one of the people involved in that is a fellow Ned Hay, who ends up creating the most popular job evaluation system after the war. So that what we see after the Second World War is a real shift from sort of fixed sharing concepts to focus on job value, and ultimately sort of analysis of competitive pay or market value. So that we see by 1950, the first executive pay survey that was done by the American Management Association in conjunction with Arch Patent of McKinsey. The same year is the commercial start of the Hay job evaluation system. And those things really sort of shift the focus over from sharing concepts to job value. Two interesting things happen in the early surveys. The measure of company size was profit initially. And one thing that happens relatively quickly during the 1950s is that the basis for measuring company magnitude or size switches from profit to sales. And so that actually is a very significant development, because as companies start to track market pay more and match it, what it means is that there now is a significant reward for sales growth regardless of profitability. So that actually has a very significant effect. And we see there's the statistical studies of pay that plot log pay against log sales. Those start in about 1952 and have continued ever since. And the basic analysis, log pay against log sales, has been there since the early 1950s. So that creates a very significant thing. But then a second sort of important thing in the development of those series is that the early compensation consultants who promoted them were sort of very big on the concept that you should match into the survey based on your performance, so that if you're not a 50 percentile performer, you should not sort of focus on the 50th percentile pay and say that's the right thing for you. That was Arch Patton, and also my good friend and mentor, Bud Crystal, who is a big compensation consultant. But gradually, that whole notion sort of gives way to the notion that everybody should pay market and that everybody should target 50th percentile pay regardless of past performance. And that turns out to have a very, very significant effect, because when you're targeting dollar pay and translating that into, say, equity shares, what it means is you're going to build in a systematic performance penalty, because if target pay is $1 million and the stock price is 20, then you need 50,000 shares to deliver $1 million of value. But if the stock price drops to 10, then you need 100,000 shares. So that once you sort of switch to the concept of everyone's entitled to 50th percentile target pay regardless of past performance, you end up building in this systematic performance penalty that really has some very significant negative consequences. And if we go back to our pay history, we were sort of back at the point of seeing that there really wasn't much in terms of financial incentive after the Second World War. So I think it's fair to say that in that period, the big incentive was promotion. And you can actually get close to the three basic objectives if you pay at the 50th percentile, so you're retaining people. You don't pay above that, so you're limiting cost. And then promotion provides a strong incentive. But that doesn't work for everybody. It doesn't work for the CEO. So one of the things you see is gradually during the post-war period, there's a return to incentives, particularly options, which are given favorable tax treatment in 1950. So that what we see is that by 1960, about 60% of executives are holding options.
Yeah, it's really evolved a lot. I think the way you describe it, it almost sounds like after the war, this idea of trying to get to continuously competitive pay is a tighter control on the amount of spending, and while maintaining sort of minimums so we don't have attrition. So you would think that would lead to less pay, but haven't we seen a big surge in executive pay over the last 40 years?
We really have. And let me actually just add one point to follow on the one you were making, was that back in the mid 1950s, there is sort of a widespread view that running a Soviet enterprise and running a U.S. business are basically the same task, and that it's largely technological and not an issue of financial incentives. That view is expressed in books like Ken Brawley's book, The New Industrial State, so that there is a sort of extended post-war period that sort of integrates Soviet and American business management as very similar. And it's easy to sort of go from there to, well, why do we really need financial incentives? That, they're not there in the Soviet Union. They managed to run these big companies or big enterprises too. So that's true. But then there is actually a big increase in pay after the Second World War. And it really picks up in about 1980. That if you look from 1950 to 1970, executive pay goes up by less than 0.5% a year. I mean, that's adjusted for inflation, but that's basically going nowhere. So that executive pay is basically flat for 20 years. And I don't have the sort of say the United Auto Workers numbers in front of me, but there would be a very material increase in their real pay over that same period. So you're getting a lot more compression in organizations and whatnot. And that starts to change in about 1980. And from 1980 until 2000, executive pay in real terms increases by 7.7% a year. And so over that 20-year period, that amounts to an increase factor of 4.4 times.
Wow.
So that we have this incredible explosion in executive pay from 1980 to or from 1980 to 2000.
So, with all these changes happening, what do you think? How would you assess what's gone on in executive pay in recent years?
Well, before we do that, let's talk about sort of why the pay explosion happened. There's just a lot of sort of controversy about that. One is that the low tax rates, which really come in with Reagan, when Kennedy was elected, the maximum marginal rate was still 91%. And so it's by the time of the Reagan Tax Act in '86, I think it gets down to 50%.
Mhm.
So one theory is that lower tax rates made executives much more aggressive in sort of pushing for higher pay.
Mhm.
Another one is that since most of the new pay was incentive pay that's riskier, another theory is that pay was going up to sort of offset the fact that you were getting paid in a riskier way.
Mhm.
So that's another theory. There's also a very sort of clever mathematical argument that CEO pay should sort of track the size of companies proportionally, sort of much like an asset management fee. And another possibility was just our own advocacy at Stern Stewart and elsewhere. But to me, I think one of the most important things is the LBOs in the 1980s sort of demonstrating that the value of a manager could actually be very large.
Mhm.
And my favorite is William Simon, who had been the Treasury Secretary. And in 1982, he buys Gibson Greetings from RCA, which was then a big conglomerate.
Mhm.
And a year later, he and his partner take it public, and they each make $70 million.
Wow.
Here you have a very clear demonstration that a small executive team can add enormous value to
Mhm.
an asset. And I've always felt that that's sort of the strongest thing behind the explosion in executive pay is sort of the perception that executives really are very valuable and can sort of add a lot of value to an organization. And sort of classic economics is that everybody should be paid their marginal product.
Mhm.
And it's interesting, there's a wonderful book on Major League Baseball by Gerald Scully called The Business of Major League Baseball. And he shows that he does a very nice model starting from revenue to sort of flow back to the player's contribution.
Mhm.
And he shows that prior to free agency, the star players got only 10 to 20% of their marginal product.
Mhm.
But that after free agency, that increased to roughly 100% on average.
Mhm.
So that, sort of after free agency, it sort of worked like economists would expect, where, a baseball player who contributes an enormous amount to the value of the team gets paid an enormous amount. So I
Mhm.
think,
Mhm.
that was definitely sort of one of the things happening on the executive pay side. Now, do you want to go back to, I think you had your sort of next question. Do you want to just
Yeah.
go
Let me
back
ask.
to that
Let me ask it
again?
again.
Okay.
What's your assessment of all these changes?
My assessment is that there hasn't been as much change as it looks like on the surface. That
Hmm.
if you look at a lot of the popular press and a lot of financial economists too, is that they focus on the fact that the percent of pay in equity was maybe 10% in 1960, 30% in the 1980, 40% in the 1990s, and then now it's 65%. So they look at that and say, there's a whole lot more stock here, much of which has to be held for 3 years as it vests.
Hmm.
And that should produce a great deal or a much stronger incentive. But if we go back to what we were talking about earlier about an executive's wealth being stock and option holdings plus the present value of expected future pay, you can see that when stock compensation is going up, you're holding more unvested stock, and that's
Hmm.
definitely strengthening your incentives. But at the same time, your expected future pay is higher. And as companies sort of move more in the direction of sort of pure competitive pay, that big piece of wealth becomes less and less sensitive to performance. And I've recently done a study that shows that um, between in 1995, um, companies would offset about 15% of the price change by reducing shares.
Hmm.
But 25 years later, they're offsetting about 85% of the price change
Hmm.
by reducing shares, which means that if you drive the price for from 10 to 20%, you've got a big gain on this year's holdings and the unvested stock, but there's very little impact on your expected future pay because they cut your shares in half.
Right. Right.
So that my assessment is that there's really a misperception that incentives are much stronger, and this is really it's not understood by institutional investors or directors or the proxy advisors. So that
Hmm.
to me, there's a lot of sort of smugness that we've got great governance
Hmm.
when it really isn't the case.
Yeah, the self-leveling of every time the share price goes up, you get fewer shares and options, and every time the price goes down, you get more shares and options is so counter to the idea of creating a long-term incentive. And on top of that, you have every year being treated like an island. So,
Yes,
why make investments that take 5 years to pay off? By the time you get there, the benefit of that's just going to be baked into your targets. So, obviously, lots of companies do overcome that and make the right decisions, but the incentives don't actually lead them there. They're doing that because they're good people, not because they're paid to do it. Um,
yes.
so let me flash back in time. We met, over 30 years ago when we worked together in the early 90s at Stern Stewart, the EVA company. Um, EVA is something you've continued to study long after you left Stern Stewart. Does EVA fix some of the problems you've been describing?
Yes, and I thought that the incentive plans that we developed at Stern Stewart were very significant and really solved a lot of the incentive problems we see in the transition from the General Motors formula to competitive pay. Because just to sort of remind or tell our audience, the plan that we developed at Stern Stewart made the bonus earned equal to a target bonus plus a fixed percentage of EVA improvement above a target or expected improvement. And the target bonus was typically calibrated to make total compensation competitive in the labor market. The sharing percentage was fixed so that it didn't go down when you did well and it didn't go up when you did poorly. And the expected improvement or the target, that was also fixed in dollars, and it was calibrated to provide the EVA improvement that investors needed to earn a cost of capital return on market value or on the market value of their investment. So that what the plan really did is it combined sort of the two strands of history, fixed sharing
Hmm.
with labor market reference, and it made the bonus earned equal to really market pay plus a fixed and symmetric share of an excess return measure. And the share of the excess return measure that could wipe out the target bonus, so that the target bonus was really sort of staked to the manager, but then subject to loss. And then in the EVA bonus plan, there was a bonus bank, so the bonus earned was usually at risk for 3 years before being fully paid out. And that basic structure of thinking of pay as really market pay plus a fixed and symmetric share of an excess return measure, that's turned out to be the underlying structure of a bunch of perfect pay plans. I later did a perfect pay plan based on stock. It was an annual grant of performance shares. Another one was Don Raymond, who was the chief investment strategist at Canada Pension Plan. He developed an optimal fee structure for investment managers that had the same underlying structure. And then there's a famous academic finance paper, Dynamic CEO Compensation, by Alex Edmonds and Xavier Gabay. And they have a plan there, and you can also show that it has the same underlying structure, that it's market pay plus a fixed and symmetric share, so that it gets away from the whole concept of backing into the sharing percentage, starting with the target market dollars. So that, to me, it was a very, very significant achievement. And a very good question, which I hope you will ask next, is, well, why wasn't it more successful?
You read my mind. That's exactly what my next question is. So, lots of companies implemented EVA in the 90s. Not that many of them kept using it, in the subsequent decades. What went wrong? Why did they stop using it?
I think there are um, two big things, one of which I think you can speak better to than me, is that I think one big factor is just that there's surprisingly little use of EVA for financial analysis. I mean, I think most companies are sophisticated enough to talk about growth and profitability, but there's a tremendous resistance to going the next step and putting them together in the EVA framework, which to me um, makes a great deal of sense and sort of simplifies things and ties it directly to discounted cash flow. And admittedly, it's not the case that it's all about current EVA. It's not just about maximizing current EVA, it's about maximizing current and future EVA. So you need to think about both. But the reluctance of analysts and CFOs to embrace an EVA measure, I think, is a big thing. The other thing I think is that um, you know the EVA bonus plan has market pay in it, but it subtly raises the standard, because for most companies, the notion is that you're entitled to competitive target pay regardless of your past performance. Whereas what the EVA bonus says is that you're only entitled to average pay in the market if you have average performance. So it reintroduces a more demanding standard of pay for performance. And I think that is a very significant negative. What we see in a lot of cases is companies dropping in EVA when there's a big industry downturn. So some of it is sort of the lack of a mechanism for that. But I think the basic problem is just that it sets to everybody to a higher standard, and people just don't go willingly along with that because they don't appreciate the benefit of it in the sort of broader sense in terms of what it does for incentives.
Yeah, that's a good explanation. Yeah, my experience with it is similar. I think there are a couple of other points. I think that EVA, at least in its purest form, is a fairly complex calculation that people find is sometimes difficult to communicate down into their organization. And on your point of how they communicate with their investors, we still get often, but our investors don't calculate that measure. Why should we use that measure when we talk about our own measures? And a few years back, I came up with a sort of response to that I continue to say all the time. Margaret Mead once said, "What people say, what people do, and what people say they do are entirely different things." And I modified that to say, go by what investors do, not what they say. These measures track share prices really well, much better than EBITDA, EPS. So even if they're not calculating it, it seems to better represent all the different things that they look at. The EVA
Yep.
captures capital intensity, EBITDA doesn't. Investors obviously care about capital intensity, and you can show that that affects share prices. So, yeah, I think it's a some of the reason it's fallen out of favor is unfortunate, but there are some companies picking up new economic profit incentives, obviously. So there is a little bit of a resurgence, I think, going on now. The next topic I'd like to turn to is one that's very important. We all owe a debt of gratitude to Michael Jensen. He was a wonderful professor. I met him many times and was always impressed with his ability to think through a situation. He passed away earlier this year, sadly. But his work on agency costs, which talks about the cost of the misalignment of interest between executives and the company's owners, is really quite important. You developed wealth leverage specifically to kind of measure the alignment between executives and owners. Can you tell us about wealth leverage? I think it's one of your best innovations.
Yes, and that's sort of start with what Mike Jensen was doing, because he and Kevin Murphy really did a wonderful empirical study designed to try and determine what's the sense or the impact of current performance on not just stock and option holdings, but on future pay. And they, in their study, which was published in an academic paper in 1990, in the same year in a Harvard Business Review article that was entitled CEO Incentives. It's not how much you pay, but how. Um, they actually did a really nice job of trying to measure incentive strength for over 400 companies. They did individual company regressions to measure pay sensitivity and things like that. So they really did a great job. But I felt that they made a basic mistake in how they characterized it at the end, because at the end they brought it down to saying that what really matters is how much the executive gets for every $1,000 that the shareholder gets. And so one of their key findings was that for the median big company CEO, there was less than $3 of gain for every $1,000 of shareholder wealth. And to me, that's the right measure to use if you're thinking about perquisites, like if you're thinking about buying a company plane. It does make sense to say, um, how much does the executive bear the cost? And if he's bearing, sort of only $3 for every thousand, he has a very weak incentive to sort of make the right decision there. But if you think about choosing a business strategy or making an acquisition, there the executive doesn't have the ability to divert that benefit to personal benefit. So there, I think a much more useful measure is the one that I've used for years, which is to say, what's the relationship between the percent change in the executive's wealth and the percent change in the shareholder's wealth? And if you think of somebody who's a pure entrepreneur where all of their wealth is in stock, there the ratio would be one, because any increase in shareholder wealth flows through to the executive. And to me, that's a much more useful measure. And it's disappointing how little progress directors, compensation consultants, and proxy advisors have made in having a useful measure of incentive strength. It's very common now for companies to rely on percent of pay at risk as a proxy for incentive strength, and that just is a terrible measure and doesn't capture at all the impact of performance on expected future pay. So that that's been a very unfortunate development. There is a promising regulatory development there's a new proxy disclosure called pay versus performance that requires companies to report 5 years of mark to market pay. And that can be used as a way to get an empirical sort of snapshot of pay level or incentive strength by calculating relative pay for each year on a cumulative basis and then relating that to relative performance. And when you do that analysis, the slope of the line gives you a measure of incentive strength, the correlation a measure of alignment, and the intercept is actually a measure of performance adjusted cost, the pay premium at industry average performance, so that there really should be much more coming out of that new disclosure. I'm hoping to do my best to make that happen, but so far I can't claim any success in that.
So you referred a little bit earlier to losing managers to private equity back in the 80s. The way private equity and hedge fund managers are paid is very different from the way executives in traditional companies are paid, public companies are paid. What are the differences? What's better about the way hedge fund managers and private equity partners are paid?
Well, let me sort of put that into two pieces. Let's first start with executive pay within companies that are owned by private equity.
Okay.
And one of the things you do find in private equity is that the directors have a much, much bigger stake in the success of the company.
Hmm.
And so I think they put much more thought into how to pay executives than
Hmm.
an ordinary public company director. And they have had a strong sort of what I would call an intuitive recognition of the whole problem of competitive pay and the performance penalty. And their response has been to really set almost all the compensation up front, is to make a upfront grant that covers the executive for the expected ownership period, and to rely more on formula bonuses. So that the first thing that's happened with private equity is that I think the incentives for the executives of the companies they own are much stronger than they are in public companies.
Hmm.
When you get to the structure of pay for the fund itself, for a hedge fund or a private equity firm, typically that structure has been an asset fee, typically 2%, and then a profit share, typically 20%. And that actually can provide a strong incentive, but it has sort of two significant weaknesses. Is that there is a high water mark, but it's also the case that if you get paid for a gain and that gain is subsequently lost, there's no mechanism to recoup it. There's no
Hmm.
bonus bank like we used at Stern Stewart. And that makes a big difference, particularly for hedge funds, which are able to take their gains out early. In
Hmm.
private equity, typically the fund managers have to wait to take their gains out until the companies are sold, so that
Hmm.
the fee structure is much more of a problem for hedge funds. And there's a recent academic study that shows that on the hedge fund side, because of the fact that subsequent losses are never recovered in terms of fees, that the effective fee, average fee across a broad universe of hedge funds is closer to 50% than the stated 12 or 20%.
Hmm.
Um, the other thing is that the asset fee can be large relative to the carried interest, because you've got 2% a year, so you're getting 20% over a 10-year period.
Hmm.
And if it's not a particularly strongly performing hedge fund or private equity fund, what that means is that the performance piece isn't that large compared to basically the fixed piece.
Hmm.
And
Hmm.
so there are a lot of cases where really the fixed fee is too big, and it should go back to the basic concept in the EVA bonus that
Hmm.
the fixed fee should be eroded by the performance fee. If you're
Hmm.
not generating the threshold return, that should start to erode the performance fee.
Hmm. Yeah, I mean, I having run an investment firm for a while myself. For very large firms, I think what you just said applies very, very much. I think for small firms, I was under 100 million in assets under management. The fixed fee mostly goes to paying costs, and then the
Mhm.
variable fee is the comp. Because the 1 or 2% that a fund gets as an asset fee, often much of that gets spent on analysts and other infrastructure costs and things like that. So maybe it is a little more aligned than you would think, just looking at, because you're really just looking at the revenue to the hedge fund when you look at the 2% and 20.
Yes. Yeah.
But good points. So we've talked a lot about executive pay. Have you? I think you've looked at director pay too, haven't you? And what did you find there?
Director pay actually has the same problems as executive pay, just worse. Is that the modern director is not at all a significant steward of personal capital. The modern director is really a service provider like management. And so the same competitive pay concepts have really carried over to director pay.
Hmm.
And one of the things you see is that the embrace of competitive pay and offsetting the price change by the share change is even more extreme among directors. That when you look at executives, now about 85% of the price change is being offset by the share change, but for directors, it's almost 95%.
Wow.
And one thing I found a great thing about the history of pay, which we didn't mention when we were talking about history, but it's really startling how different the modern director is from the historical director. When I was studying the pay plan at General Motors, at one point I compared the board in 1979 that made the first decision to drop EVA and the single
Hmm.
pool concept with the board in 1949. And a useful way to compare them was to look at their director's fee and their stock holdings and say, well, how long would the director's fee cover the loss of the expected return on their stock? And when you did that for the board in 1949, their director's fee, which was only $900, covered the loss of the expected return on the median director's stock holdings for a grand total of 2 days. But then if we go to 1979, for the median director on the GM board, the director's fee, which was then like 49,000, covered the loss of the expected return on the director's stock for 14 years.
Oh my God.
Uh, so there was just and it's just the modern director is not a significant investor in the company and
Hmm.
just doesn't have the investment needed to be really a very active and interested overseer.
Yeah, yeah, yeah. I even it's another contrast going back to private equity, right? That most of the directors are from the fund, or many of them are at least, and so they have a lot of skin in the game,
Oh, I
and
agree.
that's very
Yes.
very
Yeah.
different with public companies. Yeah, I think it's interesting. So the last thing I want to ask you about is you've done some really interesting research to develop this concept of employee value added.
Mhm.
Can you explain what this is and what your research has found?
Yes, the whole concept there is really extending the EVA notion to employees. That when we think of EVA for companies, it really is operating income after tax minus a capital charge. So it's really income minus opportunity cost. And so what I've done is tried to extend that to employees and say that an EVA like measure for an employee is really the difference between actual pay and market pay.
Mhm.
And just to be able to sort of compare or exchange between employee value added and investor value added, I look at that after tax. So it's really actual pay minus market pay after tax. And that actually, to me, is a very useful notion because it sort of takes you down the road of looking to see are firms really run as labor capital partnerships,
Mhm.
and does the value added the employee gets, does that move with the value added received by investors? And normally in my analysis, what I'll do is standardize by opportunities cost. So I'll look at employee value added relative to after tax market pay and then compare that to EVA as a percent of the capital charge. And then you can um, look at companies and see, do they, those two really track each other? Does it look like there's a real labor capital partnership? And generally, that's a very disappointing analysis. And what you find is that there are surprisingly few companies that really do have a strong correlation. There's Costco is actually one of them. Surprisingly, CVS seems to be one of them, and whatnot. But what you do find is that there's a much stronger correlation between employee value added and pay risk. So it's the employees seem to be treated much more like bondholders, that you would
Mhm.
expect for bondholders that the bond yield would go up with the riskiness of the bond.
Mhm.
And that actually is a much better characterization of employee pay than the partnership. But
Mhm.
at the same time, if you step back, you figure we've got to have partners at the top of the business running it. So at some point in the organization, they sort of switch over from a partnership perspective to more of a bondholder perspective.
Mhm.
And I'm very disappointed that they don't have sort of full employee data to be able to look at that, sort of where that transition comes and sort of how it's made. And one last point on employee value added is that the numbers are significant. That I think there were in my last study, there were 5 companies where employee value added was more than $10 billion. I mean, that included companies like Amazon and um, forget some of the, and I think Google was in that group, as well as I think Costco is also in that group. So that there is real employee value added out there, and to
Mhm.
me, this is the most useful way of thinking of the S dimension of ESG. That
Mhm.
when we think of sort of the social aspect of business, to me, a very basic starting point is how do companies treat employees, and sort of the most basic way to look at that is, are they treated either as partners or are they treated fairly as bondholders? So
Mhm.
that to me, that's an analysis that should get a lot more attention, particularly as people think about employees as stakeholders.
That's really great. I just want to build on that for 1 second before we wrap up. So, I've been really impressed with the work that Peter Stavros has been doing at KKR with giving actual
Mm.
ownership to people up and down the organization. And I think, his claim is that KKR winds up with better returns in the portfolio company because they share, some of the value creation with a much broader, group of the employees. So the if I take that and that thought and tie it back to what you were saying, would it be your position or expectation that companies that share more of the value creation up and down the organization will not just incur an extra cost, which is always oh, we can't afford to pay that, is the comment I hear when I bring it up with people, but actually that will lead to changes in behavior such that the shareholders will actually be better off. In other words, it's a positive NPV investment for them to share some of the wealth creation with the employees. Because we can think of this as we want to be fair to the employees. That's kind of the S part of ESG. But I think there's a valid point that can be made that, at least in many cases, maybe not in all cases, that actually winds up creating more value back for the shareholder because of the alignment of interest with all those employees that are making small decisions all day long up and down the organization. What are your thoughts on that?
No, I agree with that. Sort of see 3 or 4 major efforts to strengthen average employee incentives and sort of create more of a partnership. Employee ownership in ESOPs, like they're doing at KKR, is one. Franchise contracts are another. Worker cooperatives are a third, and then the EVA bonus is a fourth. To me, the big weakness of employee ownership is just that it gives you an ownership interest at a global level rather than an ownership interest at the business unit level.
Hmm.
And that's really what a franchise contract does, is that it creates an ownership like interest at the business unit level. And I
Hmm.
think that's why the franchise, to my mind, has become the single most widely used business unit incentive in America,
Hmm.
even more widely used than ESOPs. And but also, a franchise requires the employee to make a significant investment, and there's a lot more sort of legal complication and apparatus around it. So that to me, I agree that employee incentives can be a net gain for investors,
Hmm.
and but that as companies get bigger, the potential gains from ESOPs diminish, and you need to give more thought to how do you take that strong incentive down to the business unit level
Hmm.
to a more local and controllable level? And I think that was the great promise of the EVA bonus, was that
Hmm.
it provided a practical way to do that.
Right, right. As if each business unit had its own stock price almost. Yeah.
Oh, right. Yes. Yeah.
Okay, well, this has really been great. So we've been speaking with Steve O'Byrne. Thank you, Steve, for joining us. This has been a really wonderful conversation.
Oh, it's been a pleasure. Thank you very much, Greg.
You have been listening to Create More Value, sponsored by Fortuna Advisors, and I am your host, Greg Milano, founder and CEO of Fortuna Advisors. I hope you have enjoyed this episode. Fortuna Advisors helps companies with strategy, capital deployment, business management, corporate culture, and incentive compensation, all aimed at driving top quartile total shareholder return and the equivalent for private companies. To learn more, contact us at info@fortuna-advisors.com.